A stock plunges 40% from its peak. Is it the fire sale of the century, or a bottomless pit for your money? A company claims to be a market leader, yet it's losing ground in the all-important AI chip race. Is this a stock with massive potential, or is it just yesterday's news? Our bull case argues this is a cash-rich, hidden champion, perfectly positioned to ride the two massive waves of AI and robotics, and it's currently on sale. In fact, the queen of tech investing herself, Cathie Wood, has been quietly adding to her position. But our bear case says, don't be fooled. Not only has the stock crashed, but its robotics division is bleeding cash, and even its own management seems to have lost confidence in the future. They argue this is a perfectly packaged value trap. So, is Teradyne a quality stock that's been unfairly punished by the market, or is it a ticking time bomb about to explode? Welcome to the debate. We have only one goal here today: to cut through the noise, challenge the popular narratives, and empower you to make smarter, more informed investment decisions. We believe the deeper the analysis and the tougher the debate, the clearer the path forward becomes. Let's get started.
Ladies and gentlemen, today I stand before you to argue that Teradyne, trading under ticker TER, represents one of the most compelling quality potential stocks in today's market. Let me start by quickly introducing this remarkable company. Teradyne is America's leading supplier of automated test equipment for semiconductors. Essentially, they make the machines that test computer chips before they reach your smartphones, cars, and data centers. Their business generates revenue from three main sources: semiconductor testing equipment, which accounts for about 75% of their $2.8 billion annual revenue; robotics and automation through their Universal Robots division and service contracts that provide recurring income. Now, why should you consider TER as your next investment? Let me present three powerful arguments. First, Teradyne enjoys an unshakable competitive fortress. This company doesn't just compete, it dominates. They hold a commanding more than 20% global market share in semiconductor testing. And here's the kicker: they're one of only two companies worldwide capable of testing the most cutting-edge semiconductors. That's not market leadership, that's market control. Morningstar has awarded them a wide economic moat rating, recognizing their sustainable competitive advantages. When your customers include tech giants like Apple, Samsung, and TSMC, and switching to competitors would cost them millions in retooling, you've built switching costs that competitors simply cannot overcome. Second, TER is perfectly positioned for two explosive growth markets: AI semiconductors and collaborative robotics. While everyone's talking about AI stocks, few realize that every AI chip needs testing before it works. Teradyne holds an incredible 50% market share in AI system-level testing, and their AI testing revenue has exploded by over 350% year over year. But here's what makes TER truly special: their robotics division through Universal Robots is capitalizing on an even bigger opportunity. The collaborative robot market is projected to surge from $1.4 billion in 2025 to over $60 billion by 2033, growing at an astounding 36 to 42% annual growth rate. Universal Robots dominates this space with 30 to 50% market share, and they've just landed what could be their biggest breakthrough, supplying the robotic arms for Amazon's revolutionary Vulcan warehouse robot. This partnership alone could generate $400 million in revenue for Teradyne as Amazon automates up to 80% of the 14 billion items it handles annually. Finally, this is a financially bulletproof company. TER operates with a completely debt-free balance sheet and over $500 million in cash reserves. Their gross margins exceed 60%, demonstrating incredible pricing power, while generating nearly $500 million in free cash flow annually. This isn't just a growth story, it's a profitable, cash-generating machine that returns money to shareholders through dividends and buybacks. In conclusion, Teradyne combines market dominance, dual exposure to AI and robotics megatrends, and financial fortress strength in one package. While others chase speculative opportunities, TER offers you the rare combination of defensive moat protection with explosive growth potential in two of the world's most important technology trends: AI semiconductors and collaborative automation. The choice is clear. TER isn't just a quality potential stock, it's an essential building block for any serious technology portfolio positioned for the automation revolution. Thank you.
Ladies and gentlemen, my opponent just shared a glowing story about Teradyne, but let's take a serious look at the facts. TER actually carries much more risk than potential. Let me explain why. First, TER is simply overvalued. Right now, this stock has a forward PE of 28. That's nearly 50% higher than the industry average. The company also trades at a price-to-sales ratio of over 5 times, which is well above what's considered reasonable for a cyclical business. When you're paying premium multiples during an industry downturn, you're setting yourself up for disappointment when the cycle turns against you. Second, let's talk about real performance. TER is down nearly 40% from its peak this year, and it has dropped more than 30% just since January. Meanwhile, its main rivals are actually growing fast. This isn't just normal volatility. This is the market telling us something is wrong. Now, about the Universal Robots division, which sounded so promising. In reality, it's losing over $20 million just in the last quarter, and they recently had to lay off 10% of their staff. That supposed Amazon deal? There's no solid revenue from it yet, and the whole robotics division is still deep in the red. Let's not forget, Teradyne's business is super cyclical. The chip industry goes up and down, and right now it's facing a tougher period with trade issues and customers pulling back orders because of uncertainty, especially from China, which makes up nearly a fifth of its sales. Finally, my opponent claims market dominance, but Advantest is gaining ground. In the critical AI testing market, Advantest holds 55% of custom ASIC testing, while TER has just 45%. More importantly, Advantest is the exclusive testing provider for NVIDIA's AI GPUs, the fastest-growing segment. TER is fighting for scraps in a duopoly where their main competitor has the better positioning. So if you want to bet on hope and hype, maybe TER looks good. But if you care about facts and protecting your investment, TER is a high-risk, overvalued stock with fundamental problems. Thank you.
Thank you. My opponent has done an excellent job of highlighting the rearview mirror, focusing on short-term volatility and painting a picture of risk. But investing is about the road ahead, and that's where Teradyne's story becomes incredibly compelling. Let's separate the temporary noise from the long-term facts. First, let's address valuation and performance. My opponent says the stock is overvalued and has dropped. I say it's on sale. When a debt-free, best-in-class company with 60% gross margins sees its stock dip during a cyclical low, that's not a red flag, it's a green light. The market isn't telling us something is wrong, it's giving us a chance to buy a market leader at a discount right before the semiconductor test market is forecast to rebound by over 18% next year, according to Semi's year-end total semiconductor equipment forecast. The premium P/E ratio isn't a sign of risk, it's a sign of respect for a company with superior financial health and growth prospects. Second, the robotics division. A quarterly loss isn't a sign of failure, it's a sign of investment. Universal Robots is the undisputed #1 player in the collaborative robot market, a market set to grow from $1.4 billion today to over $60 billion by 2033. That's not an incremental gain, that's a 30-fold explosion. The Amazon deal is the first step in tapping this massive potential. Finally, let's talk about competition. My opponent claims Advantest is winning the AI race because they have NVIDIA. That's a very narrow view. Teradyne is playing a bigger game. They aren't tied to one customer. They have a diversified base of giants like TSMC, Samsung, and Infineon. This isn't about fighting for scraps, it's about dominating a broader, more sustainable portion of the market. So, the choice is clear. You can focus on the short-term dips, or you can see the facts. A debt-free market leader positioned for explosive growth in both AI and robotics, and currently available at a discount. The real risk isn't buying Teradyne today. It's looking back in 5 years and wishing you had.
Thank you. My opponent asks you to look at the road ahead, and I agree we should. But the road they're describing is full of potholes, and they're asking you to ignore them. First, they call this stock on sale. Let me be clear. A sale on an already overpriced item is still a bad deal. You are still paying a premium price for a company whose main rival, Advantest, is already winning the most profitable part of the market, the exclusive testing for NVIDIA's AI chips. That's not a discount. It's a risk. Second, they call the robotics division's losses an investment. But when your investment forces you to lay off 10% of your staff and publicly slash your own revenue targets, that's not a sign of future growth. It's a sign of a struggling business that is consistently failing to deliver. Finally, my opponent wants you to trust in future growth, but here's what they're not telling you. Teradyne's own management has lost confidence in their business. They've already cut their 2025 revenue guidance from 15% growth down to just 5 to 10%, and they've completely stopped providing guidance for the second half of the year. When a company's own executives won't even predict their next 6 months, why should investors bet their money on it? So you can either bet on hope that a money-losing division will suddenly become profitable and that they'll catch up to their competition, or you can look at the facts. The facts show that TER is an overvalued stock, and it is losing the race in the most important tech market today. Thank you.
Thank you. My opponent has expertly painted a picture of short-term challenges. But investing isn't about staring at your feet. It's about looking at the horizon. Let's put these points into perspective. My opponent says Teradyne is losing the AI race because one competitor has one major customer. I say, don't miss the forest for the trees. While they focus on one relationship, Teradyne is a critical partner to a much wider universe of tech giants, TSMC, Samsung, and Apple. They are deeply embedded across the entire industry, not just one part of it. This isn't weakness, it's diversified strength. They point to robotics layoffs as failure. I call it smart, decisive management. You don't prepare for a market that's set to grow 30-fold by being bloated and inefficient. You get lean, you focus, and you position yourself to capture that explosive growth. That's exactly what Teradyne is doing. And finally, they claim cutting guidance is a sign of lost confidence. That's simply not true. It's a sign of honesty and prudence in a complex global market. I'd rather have management that's realistic than one that sells hype. The fundamental facts haven't changed. Teradyne remains debt-free, a market leader, and perfectly positioned for the two biggest tech revolutions of our time, AI and robotics. So the choice tonight is simple. You can invest based on short-term fear and volatility. Or you can invest based on long-term, undeniable facts, market leadership, financial strength, and a dominant role in the future of technology. The real risk is looking back and realizing you let the noise distract you from a golden opportunity. Thank you.
Thank you. My opponent has asked you to ignore today's problems and bet on tomorrow's promises. But a promise isn't a plan, and hope is not an investment strategy. Let's look at the facts one last time. They call having many customers a strength, but the reality is, Teradyne is facing slower growth and market share loss in the critical AI testing market. They call the robotics division's layoffs smart management, but a 21% year-over-year drop in sales for that division isn't getting lean, it's a clear sign of a struggling business. And most importantly, they call weak guidance honest. But when the company's own CEO says visibility for the second half remains uncertain because customers are pushing back orders, that isn't just honesty, it's a direct warning of trouble ahead. So, the choice tonight is not between short-term fear and long-term vision. It's between a nice story and hard numbers. The numbers show an overpriced stock, a money-losing division, and a company that is falling behind in the most important technology race of our time. The real risk isn't missing out on a so-called golden opportunity. The real risk is paying a premium price today for a business with fundamental problems that are plain to see. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.